This whole thing is a huge nothing burger. This is the third deal that China has done. The other two countries are Pakistan and Brazil. And the reason why is I see like people on Twitter now breathlessly rambling on about de-dollarization and all of this stuff. And I think if any of these people would think from first principles, the first thing that you would know is that the yuan is pegged to the US dollar. And so as long as it's pegged, whether you trade through the US dollar or you don't and you directly go to yuan, you're indexed to the US dollar. And then you use a dollar swap to convert it into the currency you need. So I don't know. I think this is kind of like a lot of folks who don't really know what's going on. The reason why China has had so much dominance as a trading partner, and the reason why China's central bank has the largest amount of foreign US dollar reserves, about $3.5 trillion, is exactly because of the thing that you want to ignore in order to have this highfalutin intellectual conversation. It is pegged to the US dollar. And until it is unpegged in a free-floating currency, we will never know what the real market clearing price is.
And
so China has been able to, China has been very effectively able to manipulate this currency since they were brought into the WTO in order to engender that trading partner status. They were able to artificially suppress the value of their currency so that exports from China could gain traction in countries all around the world. You have to take into account this currency peg, and you have to ask the question, where would the currency be if it wasn't free floating? And then what would the incentives be for folks to replace the dollar? And I think that there's a lot of interesting questions there that are worth asking, but I think you have to be a little bit more intellectually honest to have the discussion. So you settle, right, across, let's just say you have two trading partners in two completely different countries that use a bank in each of their local areas. They typically swap to dollars and then they transfer, right, using this backbone of the financial infrastructure called SWIFT. China has built a competitor to it called CIPS, and China's been going around and signing folks up. Makes a ton of sense, right? Hey, listen, if we're trading between each other, let's just use that. So I think it's important to not paint this with more of a brush than it should be. I'm not saying that de-dollarization couldn't happen. I just think that everybody tries to take one random data point and conflate it all together to reinforce a Ray Dalio point from a book 3 years ago. This is also where you have to expect the Fed will really want inflation to stay high. That's sort of what we've said before. The only way out of this mathematically is to keep rates high. But the other thing, David, that when you mention all of this is, what about every other country? If you think that's happening in the United States, I think it's important to make sure we at least consider every other major economy, because it's not as if they're pristinely sitting on the sidelines while this happens to the US. This is my whole argument the whole time, which is if you're going to have this argument, you need to do it thoughtfully and relatively, right? Because the euro is in the same amount of trouble. If you look across, it's not as if China is actually sitting pretty and smelling like roses either. Every major economy or trading bloc in the world is going to go through this at the same time. So it becomes a relative trade argument. And there, I just don't know enough to know whether the US is poorly positioned versus Europe or China. But it just seems like you get back to a place where it's like, okay, we need to find the flight to safety. What is the canonical flight to safety? If it's not a commodity like gold, it's probably the dollar until it's not. This is why you have to have, if you're going to be intellectually honest, just have a relative conversation about all of the currencies and all the things that they're also going through, which are also not perfect. Just realize that if you want to go and peg your economy to somebody else's back, they also come with their own trials and tribulations that you have to risk manage as well. And now you have to decide on balance, do you want to risk manage a centrally governed economy, right, from a central bureau, or a freewheeling Democrat? Yeah, and if they don't own the building, they definitely own the debt. 100% for sure in the fixed income portfolios of all these pension systems are the debt that was used to finance these buildings. Look, Saudi Arabia, Abu Dhabi, all of the UAE, these are countries that are really important on the world stage, and increasingly so because they manage peace and prosperity regionally now, right? They have huge balance sheets that can accelerate all kinds of projects all around the world. And so they have to be taken seriously. And so this is a very smart marketing move by the PIF, which is to essentially say, look, we are an established blue chip LP of the blue chip organizations that you're used to hearing about and celebrating. And I think that's very smart of them, because what it does is it reinforces the feedback loop that other great firms should be going to them to raise capital when it comes time for them to raise their N plus first fund.